Welcome to Mongo Spaces. This Wednesday evening, we're going to be dissecting Absa Kenya's financial year 2025 results. Yusuf, you can introduce yourself for those who don't know you and where you sit within the Absa hierarchy and within the group itself. Give us a little bit of what you do and your journey to becoming CFO.
Thank you so much. My name is Yusuf Omari. I'm the finance director for Absa Bank of Kenya, looking at the core finance, looking at treasury, looking at strategy together with sustainability. From my career perspective, I started my career in KPMG as an external auditor, and then I moved in to become an internal auditor in Barclays. And then from internal audit, I moved to be the compliance director for East and West Africa. And then after that's when I joined from the bank perspective as a CFO for Absa Bank. So glad to be here.
From your strategic point of view, what are the skill sets that make a good CFO?
I think for me is not being a traditional bookkeeper, and those are the traditional accountancy roles. That, of course, is what I'm saying, don't put it as traditional. That is given. I think for me, what is significant from a CFO perspective is added value. Is being able to run the strategy for the organization, anticipate changes, come up with the key strategic initiatives, and then being disciplined in terms of supporting the execution of that strategy, monitoring on a continuous basis. And if there are tweaks, there are changes that needs to be done, then you should be there on forming and leading those changes. That way, then you're adding value rather than just being a traditional CFO who's basically reporting financials, which if you think about it is literally historical, it's backward looking. As CFO adds value, it's always forward looking.
My takeaway is value addition there. In terms of value addition and the Kenya ecosystem and to Absa Kenya as a whole, can you give us a bit of a bird's eye view on the 2025 results and how they were?
Good set of results we released today. We got a big impact on the macros last year, and this one I'm speaking to the entire industry, where we saw a sharp drop in rates around November 2024. And the 6 months TB rate was at 16%. 4 months later, that same TBL was in single digits. And that meant we price our book, both existing book and also new to bank, i.e. when you are selling new loans. That had a big impact on our financials. Our yields came down last year by 270 basis points. The logical thing, of course, then is to drop your cost of funds, the cost you're paying for your deposits. We did that, but you only managed to drop it by 170 basis points. So our margin came down by about 100 basis points. And that's simply because deposits, quite a number of them are contractual. So if you look at our financials, our net interest income was down year on year 6%. And the game changer for our revenue was our non-funded income. This grew by 12%. All our subsidiaries, all our new revenue streams like bank assurance, asset management, custody, securities, all of them recorded double-digit growth rates and effectively then cushioned the impact of the drop in rates. Overall, our revenue was down year on year 2%. So we were able to cushion that impact with our costs coming down, lots of productivity initiatives tied with tactical initiatives as well to try and cushion the impact. And then if you look at our impairment, it was down 32% with a loan loss ratio of 2%. Effectively, today we've reported a profit after tax growth of 10% and a growth in the dividend that was announced today of about 17%.
Maybe to start with the net interest income side, rates were down, I think, 250 basis points, as you said, in 2025. Is that having an impact in terms of uptake of loans? Do you see customers interested in perhaps taking up more loans because the rates are lower? How is that evolving from your perspective and your vantage point?
So this sharp in rates happened so rapid. The customers, especially on the side of consumer, personal household sectors, it takes time for them to be able to respond to favorable rates for the simple reason that there's an issue of planning, there's an issue of room for them to be able to borrow additional amounts, but also more fundamental, 2024 is a year where we had quite a number of taxes introduced. So the issue of disposable income was a concern. So the growth, the uptake was very slow from the consumer and SME side. On the corporate side, it was a huge relief. Corporates, normally, if you look at their facilities, are short-term. You don't get corporates, the majority of corporates going for long-term loans. It's normally trade loans, which they're able to repay within a very short time. Or even if they take term loans, you'll find a huge repayment within the first year. So that's where we saw growth. So if you look at our asset book, growth on the corporate side, but then for consumer and SME, it was actually a drop year on year. Having said that, this year is 1 year down the lane, predictability of the macros, we are now starting to see upticks now coming from the consumer side as well.
That's really positive given how 2025 was in terms of consumers' squeezed income. But when you look at the provisions, they were down year over year, I think 32% or so. And then NPLs are also down. What's driving that evolution in terms of NPLs being lower and provisions being lower? And is that something that you're seeing maybe going into 2026, especially given around the corner, there's also the big thing that is coming up, the elections that are coming up in 2027. That's pretty positive, but do you see that trend continuing?
Yeah, this trend should continue. Whenever you have stability in the macros, then people are able to plan. We don't get those shocks, whether it's interest rates going up or coming down sharply. That stability has effectively assisted in terms of bringing NPL down. And there's also the component of the government is a very big consumer of the general business in a country. So where you have unpaid bills, of course, that has an impact. We've seen a significant portion of unpaid bills, especially on the side of infrastructure being paid last year. There was the infrastructure bond that we actually supported ourselves as well as Absa. So that, together with a stable prevailing macros, has assisted in bringing NPLs for the entire industry. Industry now at 15.5. If you look at ours, it's 12.3. And the gross non-performing loans are coming down as well. Now, looking forward, this year, we are starting to see campaigns. So there's an element of political risk that is coming to in 2026. Of course, that will increase when we move into 2027. But I think the one that is right now a reality, and depending on what happens, that could have a major impact is the geopolitical risk. The war in Iran with Israel, the US, that can have a massive impact, especially if it goes on for a long time. We've seen the crude oil prices already going up. We are seeing channels that have been used being disrupted. There's the one channel that literally accounts for a fifth of all the oil and logistics of transporting oil in the entire world. If that continues, then of course that will have a spillover effect on inflation on the side of FX. Businesses that are dealing with exports and imports will be impacted, and NPL effectively you'll see a strain coming through that area. So yes, stable now, but quite a number of risks that need to be managed.
Should rates evolve to be a bit more stable this year? Is that something that would boost your top line? Maybe you catch up in terms of charging interest rates to customer loans. Is that something that would boost your top line?
Yeah, that will definitely. With stability, today we can plan. We are writing deposits. You can be able to write term deposits. For argument's sake, you do it at say 6 or 7%. If you don't have a sharp drop in rates, then you're able to manage your interest rate risk environment, which, to be honest, last year was very difficult because of that massive drop. So stability in the rates ensures predictability, ensures we can be able to price appropriately. And through that, then we should be able to see top line revenue picking up.
You did gain some share in the non-funded side, especially on FX. Now, could you talk a little bit through those kind of initiatives that you have in that is helping you maybe become better in terms of gaining market share in FX market? And then the FX market has been pretty stable for a year. Is boring good in that regard?
If you speak to the traders themselves, stable is boring. I'm sure even right now with the geopolitical risks, traders are really looking forward to that and how they manage that. But I think for us, that's quite important. That's creates stability, assists our customers, because we have quite a number of customers. 30% of our book in terms of lending is actually in foreign currency. So getting that stability is quite important. And we've seen the shillings to the dollar at a rate of 129 over 2 years now. So that's quite positive. The flip side to that then is if you look at the FX line for all the banks, the entire industry, year on year it's come down, but it's coming down because we are coming from an environment where it was unpredictable, volatile. Exchange rate to the dollar was a high of 160 shillings. So that at that time, of course, the revenue for banks picked up just on that specific line. But the environment we want is where it's stable. Our FX is down only 2%. The industry in Q3 was quite high. It was in double-digit drop rates, which basically just tells you then we have options. We've done significant investments in that area. We've developed tools, digital tools that basically increase the volume. So rather than making your revenue from margins, you drive that through volumes. And that's why we've been able to put on that massive drop that we're seeing in the rest of the industry.
And then when you go to OPEX, your OPEX is significantly down, I think around 4 billion. What's driving that? Should customers or at least investors be aware that you're not investing in the future? Are you managing costs in such a good way that you're able to grow your top line without a little bit too much pressure in terms of costs?
We started our cost-income ratio back in 2015 at 59%. That came down. If you look at what we've shared today, we were looking at the last 5 years from a high of 46 5 years ago to now where we are 37%. We believe our cost to income ratio should be around between 40 all the way to 45%. So low 40s. 2025 is unique for us because we put a lot of measures. There's an ongoing one which will continue: productivity, cost takeouts through efficiencies like automation, using robotics, alternate channels for our customers. Now 94% of the transactions going outside the traditional brick and mortar branches. Lots of digitizing of the customer journey. Right now we're doing over 71% of that, which is quite impressive. Through that, then you're able to drive efficiency. Tactical for last year, which I'm saying is a unique simply because the impact on the revenue, we had to take management actions. So one of the management action is where you drive costs down where discretion is involved. So issues like, for example, travel, we cut down on travel last year just to be able to cushion the impact on the revenue. Again, for us, I think we see a big investments. We are looking at spends of between 2 and 3 billion in technology every year. So it's an investment that will continue. When I look at our MTP plans for the next 3 years, that cost to income ratio is around the ranges of what I've mentioned, 40 to 45. So you should expect that even in friends last year simply because of those actions we took to cushion the impact.
One interesting thing, especially as the rates go lower, I expected to see a little less lending to government, but I think in your balance sheet, there's an increase in that regard. And then, of course, if you compare that to loan growth, which is around 1%, that usually is a little bit of a worry sometimes to investors. What would you say is driving that bit of investment in government securities? Are you just putting the money there just for now as you wait for customers' demand to pick up?
Absolutely. That's the main reason. We are able to support our corporate clients, commercial, BB customers. They continued borrowing and we were able to support them. We've done some of the biggest deals here in the country. You look at the EABL deal, the acquisition of shares by Zaki. We know about that one. I mentioned the one for the roads board support that we give there. Financing big deals like the ones for Sun King are the biggest domestic solar providers. So on the corporate side, we're able to support that. On the consumer, which is the one I call personal household sector, that was going to have a drag. Bringing rates down does not mean that demand picks up immediately. So we didn't have those avenues. And so for that reason, of course, we can't have idle cash. We invested in government securities.
Speaking of CIB especially, you did well, that MTN and a lot of other deals that you involved last year. But there's a new player in the market from the South African market who also wants to eat into that bit, and they're quite pretty good at CIB. Is that something that is worrying you at all, or because you already have your foot on the ground, you are ready to fight it out, so to speak?
Yeah, we have quite a number of other players, not just the ones who have come in. I think at the end of the day, this actually helps to assist the economy to thrive. If we look at the deals that are available, that are going on right now as we're speaking, some of them actually even being funded from out. So having banks that can be able to finance these large deals is actually a welcome status. But again, to what you said, we have our foot on the ground. We have quite a big chunk of the corporates that are already banking with us. We are their primary bankers. And so we see an opportunity for us, even with the new entrants. And I don't think it will just be them. I think you'll see more and more that entrants coming in, especially with the capital limitations. So we've seen banks that are looking for opportunities to either they emerge or get acquired. And so with that, you'll find quite a number of banks being attracted, foreign banks being attracted. So that competition will still go on.
When listening to the rivals just arrived, I think one of the highlights, of course, is that in the other markets, they're also facing capital calls. And I think that's one reason why they're coming to Kenya. And of course, Kenya also itself, there are banks which are looking to be acquired, perhaps because they don't meet the capital requirements, especially given that there was to meet 3 billion last year, 5 billion this year, and on a growing scale, they need to be at 10 billion by 2029 or so. So are you in the market, perhaps yourself, to look around for some of these meaty products to maybe dig your teeth into? Is that something that you're looking around for? If something becomes available?
We are open, to be honest. We have our new group CEO, Kenny Sila.
Around last month. Anything that we may need to know from his visit? It's really interesting when you see CEOs come around.
Yeah, I think he's made it very clear. The ambition for us to grow market share has already been spelled out. He's also made an announcement that we want to be top 3 in all the jurisdictions that we have a presence. We are in about 13 countries at this point in time. There are countries where we have leadership position, and there are countries where we are position 5, 6, etc. One of his ambition is in all of these countries, top 3, because scale drives the banking industry at this point in time. So we are pursuing both organic play, and of course, we are open also for any opportunities from an inorganic perspective. I think treading carefully on the inorganic side is the key here. Whoever you're acquiring, you're looking for either acquiring a capability that you don't have, acquiring new markets that you don't have, or going for scale. So with that in mind, it doesn't mean just going for a tier 2, tier 3 bank without being able to address the 3 areas that I've mentioned.
In terms of value proposition, and I wanted to highlight especially your growth around the bank assurance side, the non-funded income side, asset management, bank assurance, securities, trading, custody, which contributes around 7% to total revenue. How are these businesses doing? Maybe you can highlight that and perhaps give us a little bit of a flavor on why, if there are people in the audience who want to come and bank with you, why should they come to you? A bit of value proposition to them.
I think the biggest value, to be honest, is security. Today, you're giving your hard-earned cash for someone to invest for you. So I'm taking, for example, the asset management business. They promise you they'll give you returns of 15, 20, 30. That is very good. But having that security that indeed on areas of governance, areas on assurance on that return is where really at the end of the day becomes very important. We've seen situations where people do take their funds with a promising of very high returns, and then they lose even the principal. So here comes Absa, introduce a new product. Asset management business was, I don't know what market position it was. Fast track that, I think now we are like 3 or 4 years into this business, and we're already top 3 in the industry. It just tells you the element of confidence. If you look at the brand Absa, one thing that really spells out there is security. So you are secure, the governance is at the highest level. And so you might not get the 30% return, but when you get 15, 16, 17%, you are comfortable with that because you know that is actually assured. So I've given that example just for the asset management business, but it comes across everything else. Our securities business, our custodial business, all of this, there's an element of the strength of the brand and the confidence that our customers get knowing how strong that brand is. And that to me would be the CVT I would give to any prospective client.
Could you highlight those other segments, how they're doing then?
All of them are doing very well. Bank assurance growth year on year in this reporting period is 37% up in revenue. Asset management, the one that I mentioned, they are now top 3. They've grown their assets under management. They've increased their revenue, literally doubled their revenue. Today we say 97% growth year on their revenue. Very promising in that area. Securities business, over 20% revenue growth. Custody is the latest subsidiary that we started last year, literally just slightly over a year since we started the operations, and already very promising. Assets under custody right now is 70 billion. So all these subsidiaries are doing well. We have our digital lending proposition. We call it Timiza. Also that one picking up so well, even from a balance sheet perspective, and looking to launch some very exciting digital solutions later this year. For any investments we've done, the subsidiaries, all of them heading in the right direction. and the fact that some of them are really at infancy level. And so the deltas, we don't speak so much of the deltas, but in terms of the market share, that's where we are looking at.
Something I wanted to highlight, ETFs. You brought to market an ETF to the NSE, the Citrix MSCI World ETF. In that market, you're pretty big players now. Could you tell us a little bit about it? Because that's very interesting in terms of allowing people to invest globally using locally based ETFs.
That's an area that had not been tried and tested locally. So bringing that solution, especially for our sophisticated clients, was a huge relief. We've seen significant uptakes in terms of the solution itself and quite a number of inquiries, even for the ones who have not been able to embrace the products themselves. So doing very well. And also noting that customers are reaching a point where they're looking at different investment classes, and this basically gives them an opportunity for them to be able to diversify.
And now let's go to profitability. Some of the key drivers in terms of profitability, as you said, a little bit the cost discipline that you have, lower impairments. And how sustainable are some of these things that are driving your profitability? I think that's one of the things that investors would want to understand. And then in relation to that, as you could speak a little bit about now, once the profit is in, you want to retain some of it and share it with the investors. So you have a dividend payout ratio of around 49%, but historically, if I look at your data of the last 15 years or so, you're around 60%. So a little bit below average. It's higher than last year's, but what's it trending towards, and what's your thinking around retaining capital and giving it as dividends? So profitability and dividend strategy.
I think we're very clear. Our growth must come from the top line, our efficiency and impairment. Those are key drivers, focus area. But our number one focus is top line. So we should expect balance sheet uptake this year. You should expect revenue uptake. Last year, if you look at the last 5 or 6 years, is the first time we're showing a drop in revenue. Actually, the last time we did it was during COVID. So it's been consistent, but last year again, very unique, noting what happened in the macro environment. We have a policy where we say we will pay our dividend payout ratio is 50% of the profit. So it could be -1 or +1. Ballpark, even for this period when it's 49, it's around that 50%. We do the planning way in advance. So depending on how you end the year, it could be 50, it could be 49, it could be 52. Having said that, we do a lot of sensitivity on our capital. We look at our MTP plan. I have our budget for the next 3 years. I know the capital demand for that period, and we're able to do the dividend plan as well over that period. We ensure consistency of how much we pay. If you look at our dividend, we avoid paying 2 shillings this year and then next year paying 1.5. Whatever we pay, we say it's sustainable in the future, and we try to make sure that we can only go up. So that becomes another criteria that we use. But having said that, today we also, when we release our result, we say we have reviewed our dividend policy, payout ratio not to be just 50%. We are now scaling that up to 55%. Why we do that is because what I've mentioned, we have our MTP plans and we see it's actually affordable, and we can be able to pay now more to our investors, more than what we've been doing in the past.
I should say, looking at one of your slides, I think slide 28 in the presentation today, it shows clearly that I think you've raised dividends 23% in 2022, 15% in 2023, 13% in 2024, and this year 17%. So that's almost double the dividend payout that you did in 2021. And your market cap alone has doubled since 2023. So it's pretty robust in terms of how you are giving dividends to investors and the returns that are happening over there. Congratulations to you, I should say, in terms of delivering that to investors. And the ROE itself is pretty robust, around 23%. Anything you want to add in that regard in some of those numbers that I've pointed out?
What we always tell our investors is don't just look at the dividend. And you've already touched on that. Think of also the appreciation of the stock itself. If I am a shareholder today, I will not even be excited about the dividend payout. I will be more excited looking at my capital appreciation. That has picked up significantly. Last year, you look at our share price in 2024 at 18, you see how that has evolved to this year, picking up very well. And you look at it back in 2023, you're literally doubling the share price. I think the naked figure right now is even much higher. I think it's about 32 shillings per share. So a consistent performance on the share price, but then also the assurance that it comes through when you look at the dividend as well.
Something that you reiterated today that stood out for me is that you're very focused on branches, in actually having more branches. So could you tell our listeners a little bit on how that is going? I think a lot of people think banks are closing branches, but then you would want to have that presence, that local presence. How does that manifest in terms of overall strategy as you think about it?
I think it's just studying the consumer preferences. There are areas where we've seen consumers or clients basically preferring a lot of digital channels. So we've seen an uptick in digitally active customers. But then there are areas where customers prefer to come to the branches. Or if not the branches, they want to bank with a bank that is physically in their localities. The latest branch we've opened is in Northeastern, it's in Wajir. You don't go by road there, you actually fly to Wajir. But we tried penetrating that market. We've offered all the digital solutions, etc. We were unable. And now we are opening a branch, and we've seen quite a number of customers in Wajir embracing, wanting now to bank with us. They're giving us a lot of feedback. We are seeing the business picking up. So it's literally studying customer behavior. Having a physical presence is very important, especially here in Kenya. I know in other jurisdictions, you may just be digital completely, but we've seen a lot of our customers still coming to the branches. The number one transactions that still go through our branches today is cash. As much as we say we use digital wallets, we use cards, etc., still cash is king. And we've seen quite a number of customers still coming to the branches with cash or withdrawing cash. So we have to respond to that. How we are looking at our branches is more in terms of looking at resizing the branch size. There are times we have big banking hall, we are cutting that. So that's it already happening. We are looking at proximity of our branches to each other. We used to have a branch that was, I think, 300 meters. There were 300 meters apart. Another one was even 200 meters apart. We closed both ones. Zero impact on the customer. So there's a lot of that. Resizing of the branches, closing some, but really our strategy is to be able to go and increase the number of branches. Last year alone, we opened 4 branches. This year, we are planning for more additional branches. We're in 36 counties at this point in time. We want to expand that. And at the end of the day, it's always the CVP. What are we bringing to our clients in Wajir? Why will we be relevant when we go to Wajir? That's a question we have to answer before opening any branch.
I think that ties into one question that someone is also sharing here, asking what would make a customer choose Absa over a standalone fund manager, especially when it comes to bank assurance and asset management, or an insurer with a deeper expertise. So why Absa? So I think we've said this before, but someone wants to specifically hear you say why bank assurance, asset management, and insurance products, maybe they should come to you.
So without repeating the element of the confidence you have with the brand, the governance process that we follow, if you think about bank assurance, we are not manufacturing. We are not in the manufacturing side of insurance. It's literally a brokerage. So from that perspective, we open it up to all our clients to be able to insure with the insurance company of their choice. What we are doing is we are coming in as a brokerage, bringing these solutions closer to them, and then, of course, doing proper due diligence in terms of which insurance companies we are bringing to our panel, and we open it up to our customers. So there's a relevance in terms of where we are directly manufacturing, giving the solution like the one for asset managers, where we're giving you that confidence. The returns are very good. They might not be at those levels that some have had announcing 30%, but you have that assurance that your funds, your assets are safe, your capital investment is safe. To me, that is quite important. I think the other one, which I've already mentioned, is we are open. We are partnering with quite a number of the other providers just to make sure we are bringing these solutions to yourself. I think the last one for me is, as our customer, today our product holding per customer in Absa is on average around 3, i.e. a customer does not just come to open a current account with us. They open a current account, they have a credit card, and maybe they have a loan. So by giving these other solutions, you'll find we'll be able to increase our product holding. So you might find not just a current account, a credit card, and a loan. You find this same customer also has taken insurance with us. This customer has put some funds aside and given it to our asset managers for them to be able to invest. So through that, then it's a one shop where our customer, they don't have to move their funds. We know them, we do an array of services with them, and then this can be able to grow, then be able to grow with them.
On the regulatory side, there was the introduction of the risk-based lending and that bit of being tied to CBR. Is that having any impact? And also, there was also a suggestion by CBK to change license fees from branch-based to percentage of revenue. Is that something that you'd see having an impact going forward?
I think the move for having a uniform benchmark rate is really welcome. That is something that we've really been looking forward to. Last year, when I mentioned that our rates came down significantly, and you'll notice there are quite a number of other banks, without mentioning these banks, where the opposite happened. While CBR was coming down, the banks who actually rates were going up because depending on what benchmark rates were, last year we were using ABR, Absa reference rate, which was tied to the 6-month TB rate. The banks which had their own unique benchmark rates, which were not in line with observable market trends like the TBs. Now with this, uniformity comes in. It helps the regulator to be able to pass through monetary policies to the economy very fast. CBR came down by 25 basis points last month. All the banks have dropped. Last year, 270 basis point drop in CBR. There are some banks which dropped, some which went up, and some which dropped maybe 50% on the impact. And so effectively, you're not passing this benefit to the customer. So it's a welcome move. And there are two rates banks have been given, either CBR or Kesonia. Majority of the banks started with CBR because Kesonia meant we had to do some investments in our core banking system. I believe, including ourselves, we are now in a good position. We can be able now to use Kesonia as well. In terms of what the regulator wants to use for licensing, I think it's still under discussion. We've seen the regulator quite consulting, lots of discussions with the industry players so that whatever is being introduced, the input of the industry is there. Certainly we saw that with Kesonia. I think the only surprising thing that happened with Kesonia, which was announced again a month ago, was whenever there is a change in CBR, there's no notice to the customer. It's actually applied immediately. That was a surprise for us because we normally want to give our customers 1 month's notice. And this one, we're looking at it both in terms of when the rates go up or when the rates go down, and also giving banks an opportunity for them to be able to reprice. But we are handling that. We're having those discussions with the regulator. So even for these other proposals we mentioned, it will be consultative processes and then be able to then settle after the stakeholders have shared their views.
You engage a lot with SMEs, by the way. What are they saying about how they're feeling about the state of the economy, especially going into the new year? And then with that, you can also give us the outlook for you and as a bank for this year. It's 2 months and a couple of days into the new year. And there's a lot happening already, which is shaking up. I just realized that this is day 5 of the war in Iran. So I think things happen really fast. In terms of where you sit, and since you have a lot of engagement with SMEs, how do they feel about this year? And how do you feel about this year? What's your outlook?
SME have complained. SME, even with the stability in rates last year, there's been a lot of negative views. The debt kind of saying money is not circulating in the economy, etc. And hence, what is evident when you look at our book, SME and personal household sectors were the biggest affected sectors last year. Of course, the increase in taxes back in 2024 has had an impact to their businesses. Having said that, with stability in rates, second year, you can be able to maintain these stable macros. We've seen the rating agencies improving their ratings. We've seen Moody improving the Kenya rating. And all of this then means we will continue having a pool of cheap funds to the SMEs and the other sectors as well. I think the biggest caveat which I'm putting here, which is what we've mentioned again, is the geopolitical risk. Depending on what happens there, if that can be concluded very soon, then we're okay. If it continues past a month, goes to 2 months, I had Trump say this should be cleared in the next 5 weeks. But then if it goes beyond that, then the impact will be felt even in country. In terms of the outlook, Touchwood putting a caveat on the geopolitical risk, we've seen balance sheet momentum picking up this year, significantly more than what we saw last year. I mentioned our cost-to-income ratio to be in the low 40s, so that's what we are targeting. When I look at our budget and the focus that we have for the year, the ROE, we are always targeting our return on equity to be as a minimum 5% above our cost of equity at the moment, now it's 17%. And then in terms of the asset quality of our portfolio, we are still looking to have this improved further this year and certainly below what we are seeing as the industry average. So that would be the guidance I would be able to share with the team.
Thank you, Yusuf. So perhaps now as we close, I can give you a minute or so to tell us maybe the key things you want our listeners and investors to definitely remember about this conversation today, the key takeaways. And then at the end also you can share any book that you're reading currently or any thoughtful piece of writing that you've come across lately that you may want to share with our listeners.
I think for me is number one, good set of results that we shared with the investors today, including the big challenges that we had in our macros last year. The outlook from a macro perspective, quite stable. If we can be able to manage this all the way to the end of this year, I think a big plus for the economy. That's how I'll basically look at. On the government side, the monetary policies are basically working. The big issue caveat there is twofold. One is the fiscal policies. The spending discipline for the government is quite important to be able to make it affordable and manage the borrowing from a government perspective. I know we mentioned geopolitical risk. The political risk in the country is still there. And so we are monitoring that. In terms of the outlook, we are looking at momentum from a balance sheet perspective, which is where I was saying top line growth. That becomes a major focus for us. I think the last comment I'll mention here is for us, customer is everything. How we solution customer problems, how we support our customers' response to their unique needs is a number one concern for us. All the solutions that I've mentioned, asset management, custody business, all of these we are responding to customer needs, and we should be able to then be able to see that continue even in this year. We have a new group CEO, very ambitious, very passionate on customer. And we've seen him in the country last month. And he basically articulated the same thing that I'm basically sharing. I think lastly, the book I'm reading is called The 12-Week Year Planner by Brian Moran. This really helps in terms of having a very concise plan with key milestone dates, but then really focusing on the areas that you must deliver in this year in a very concise manner.
There's one thing I noted when you told us about your background, and someone has actually noted it. I just want to push it as one last question to you. Are you from an audit compliance background? Usually we tend to think CFOs as coming from the accountant side, but you're more from the audit compliance and now finance side. Someone is asking, how has this risk background shaped how you think about capital allocation decisions that perhaps pure finance people might approach differently?
I think the background helps me. My big background really is on external audit. When I started working in KPMG, I worked there for about 4 years, all the way to being an audit manager. I audited quite a number of financial institutions at that point in time. That background has really helped me to be able to understand not just the traditional role of a CFO, but then the unique strategic position of CFOs, literally being deputies to their CEOs and helping in terms of driving strategy. So with that, then what I have done is I've hired a team of experts within finance. I have a team of about 70 employees, all of them with my team leaders, experts in their areas. We have experts in treasury, experts in financial decision support, an excellent financial controller, and strategy. Head was helping to put all of this together. And so with all of this, then all my work then is easier. I can now focus more on the execution and pushing on the strategy rather than wondering what is happening on our GL, because I know that control has already been addressed.
Thank you for your time this evening. And we'll see you next time again with an even better set of results, I should say.
Thank you. Thank you so much. I'm very glad to be here.